The hanging man signal. The hanging man signal is a predictor of a market reversal. It occurs at the top of an upward trend and indicates a switch to a bearish market. This signal is very similar to the hammer signal in appearance, and in fact, that prior and subsequent trading days are important to its interpretation. It is dissimilar to the hammer signal in what it predicts. What is the hanging man signal? The hanging man is a one candlestick signal. This Japanese candlestick has a short body, no or virtually no upper shadow, and a lower shadow that is at least twice the length of the candle itself. The hanging man signal looks like the hammer signal, and it is important not to confuse the two. The hanging man signal is always preceded by an established upward market. It is confirmed by a following downward day. Interpreting the hanging man signal. The body of the hanging man candle can be either white or black. Either an up or down day fits the picture. The two critical factors are that there is no upper shadow or a very tiny one, and that the lower shadow is long, at least twice the length of the body. As this signal occurs at the top of a bull market, the downward trading for the day can be seen as selling pressure by those who believe that the bull market has run its course. When this selling pressure starts again the next day and drives the equity price down, it is a confirmation of the hanging man signal. Without a pre-existing upward trend and without a subsequent downward day to confirm, traders should be wary in interpreting this signal to mean a market reversal. Even better news. There are factors that provide a stronger indication that the hanging man will usher in a down market. One is a longer lower shadow. A long lower shadow indicates substantially more buying pressure on the day in question. If the equity gaps up on the day of the hanging man signal, it is a strong indication of a reversal, providing that the day following trades lower. What does it all mean? Think of overbought and underbought markets. Investors have decided that XYZ Corporation is growing and will see an ever-increasing stock price. As often happens, more and more investors jump in, and the price of XYZ moves beyond what hopeful investing, not to mention the fundamentals, will support. There comes a point when early investors decide to take a little stock off the table, and they sell. Contrarians decide that this is a stock to short. Finally, the number of sellers comes to equal the number of new buyers, and we see a day in which sellers take the stock price down significantly before buyers drive it up at day's end. When the next day opens, the price of XYZ falls. Those who believe that the stock was overbought were right, and the stock goes into a downward trend. However, technical analysis with Japanese candlesticks, such as the hanging man signal, does not require a specific set of fundamental reasons why XYZ price reversed course. The value of these signals is that they profitably predict price movement change regardless of fundamental cause. Learn to use the hanging man signal and learn to profit from the conversion of a bull market to a bear market.